Price of US oil topped $90 per barrel for the first time in over 7 years, since 2014. Now, what's the reason for this? Well, as with the price of anything, it always comes down to supply and demand. But there are a few things, like with oil, where there's some artificial scarcity or artificial influence on the supply or the demand imposed on the market by certain actors. Add on top of that a lot of the volatility that we've seen in markets over the last couple of years and poor choices by leadership around the world for the last couple of years. We have the makings of a long-term bull market in oil still in front of us. Ready? Let's dive in. Since I've been making videos, I've made a total of 3 YouTube videos regarding oil. I don't talk about it that much. The first video I made was in April of 2020 after oil briefly dipped into negative territory. Because as we all probably remember, demand for oil dried up so severely that producers were offering to pay you to take delivery of it because everywhere that existed to store oil was already full. This meant that you could literally get paid to buy the oil, hold on to it, and then later you could get paid again to sell the oil once prices had gone back up. Unfortunately, though, the only reason why a situation like this would ever come up is basically because nobody has the ability to take advantage of it. But what it did do is it forced some future supply issues onto the market. Production took a hit. And with oil, it's not like a light switch. Once you shut a well off, many times it will never start producing again. Now, my next 2 videos about oil that I've made in the past, one of them was in February of 21, so just about 1 year ago now, and the other one was in September of 21. In both of these videos, I described the macro setup and how it looks like for oil we are primed for a long-term bull market. Basically, the oil situation around the world right now looks very similar to the Social Security situation. You've got a pool available that's being paid out to people. You've got a pool for Social Security, a pool of existing oil that's already above the ground. There's a lot more leaving that pool than there is new coming in. And that means the total available reserves are slowly draining. Now, Social Security, what they'll end up doing is just printing more money because they can do that with the press of a button. You can't do that with oil, and it takes years to bring new production online. And at the rate that they're developing new production and exploring and looking for new wells, it's not going to be anytime soon that production starts to match or catches up with demand. Now, if you look at the dates of the last 3 videos that I've made about oil on the chart of oil, you can see that it has been volatile, but has been moving steadily higher since then. Leading up to this Friday, where US oil prices reached $90 a barrel for the first time in over 7 years. Last time they were this high, 2014. Now, I stated earlier that, again, this is a price, so it's all about supply and demand. That is true. But what most people usually ignore is the other side of the equation in every transaction. Because every time you buy or sell something, there's 2 things being exchanged. On one side, you've got the product or service or commodity, in this case, oil. And on the other side, you've got the money. In the US, most international trade, and with oil, that money is the dollar. So the recent fall in the value of the dollar contributed to the rise in the price of oil. That was partly due to the value of the dollar declining relative to everything else. It was also partly due to the value of oil rising relative to everything else. Simply stated, it takes more dollars to get the same amount of oil. But that brings up the question, why is oil priced in dollars? Well, this is going to sound like an odd analogy at first, but it's the same reason why the United States government charges taxes. The US enforces taxation not because it needs the money. Every dollar it receives from tax receipts, they could destroy it and they would have no problem continuing to pay every single bill. Because the government spends money into existence via debt monetization, that means they borrow money, and that debt is financed by the Federal Reserve that prints that money into existence. So it doesn't need the money it collects from taxes. Taxes simply give the dollar what some people call intrinsic value. I don't like that term, but it serves the purpose for this explanation. If you don't collect enough dollars throughout the course of the year to give some of them back to the government, you go to jail. In other words, the government uses its monopoly on violence to get what it wants. In a similar way, oil is priced in dollars. Now this started because after World War II, none of the European countries had any gold left, but America had gold. So they all said, hey, we'll just back up our currencies with dollars and we'll trust the United States because they've got a bunch of gold, and so at any time we can just redeem our dollars for gold. And then over the next 30 years, the United States printed more and more dollars to the point where there was not enough gold to redeem all the dollars that had been spent out to the world. The rest of the world went and tried to redeem their dollars for gold like the US promised, and then the United States just said, no, we're not going to give you the gold because it didn't have enough. But at that point, the rest of the world had already been using dollars for so long that the system still stuck. So the dollars still have some intrinsic value because you have to get your hands on dollars in order to do international trade, especially get oil. But that begs the question, that was 50 years ago. Why are these contracts still denominated in dollars? Well, I don't know for sure, but it might have something to do with the fact that the United States is the only country on Earth that has a military base in or near every country on Earth. In other words, the government uses its monopoly on violence to get what it wants. In any case, this has contributed to a rise in the price of oil recently, and it does not look like it is going to be slowing down anytime soon, especially given OPEC's short meeting recently. They had a meeting, it was the shortest meeting on record, and they were there to discuss whether they should increase production past their regularly scheduled kind of auto drip. Right now, they're producing an additional 400,000 barrels per day. Shortest meeting on record to basically say, nope, we're going to stick with the auto drip. So in the short term, this recent spike in oil price that's been caused by low production, increased demand, volatility in the dollar, and volatility in production given extreme weather in certain places around the world, it's possible this spike might be overextended short term. We'll almost certainly see future drops in the price of oil and more volatility. But the long-term setup is still very clear, meaning we should see much higher prices over the coming 5 to 10 years. Finally, I will be speaking at an event in Dallas on March 5th. I'd love to see you there. If you're able to join, I've got a sign-up link in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.